Bitcoin just lost the $67,000 level, and the charts look like something is breaking. Here is the thing. The flows say it isn't. This is what it looks like when crypto doesn't crash. It just gets outbid. Start with the damage. Bitcoin fell to around $66,500, down about 7% on the day, putting February's lows near $60,000 back on the table. Ether dropped roughly 7% too, slipping under $1,900. Red across the majors. But the size of the move isn't the real story. Where the money went is. So where did it go? Into the AI trade. The desks watching the flows are nearly unanimous. This is rotation, not a crypto problem. Binance research says capital is being pulled into US equities, AI, semiconductors, defense, and that in past episodes like this one, Bitcoin bottomed within weeks, not months. The clearest tell came overnight when Google lined up an $80 billion raise for AI, $10 billion of it from Berkshire Hathaway. That is where the money is going. Not here. Not yet. And the proof it is, flows, not fear, is in the ETF tape. US spot Bitcoin funds just logged a 12th straight day of net outflows, roughly $500 million leaving in a single session. Now, when you see a headline that BlackRock is moving Bitcoin to Coinbase, here is what is actually happening. Investors are cashing out of the iShares fund. When they redeem their shares, the fund is forced to deliver the underlying Bitcoin to settle them, and that means sending coins to an exchange. BlackRock isn't selling its own bet. It doesn't have one. The fund holds Bitcoin on behalf of its shareholders, and right now those shareholders are the ones heading for the door. Contrast that with strategy. Michael Saylor's company sold Bitcoin for the first time in 4 years. Just 32 coins, about $2.5 million, to cover preferred stock payments. Tiny in dollars. Loud in symbolism, because never selling was the whole brand. And the difference is the point. Strategy owns its Bitcoin, so when it sells, that is a decision. BlackRock's fund doesn't, so when it sells, that is just plumbing. If you want the part of crypto that is actually winning while Bitcoin bleeds, look at Hyperliquid. The Wall Street Journal reported that traditional traders are now using it to trade perpetual futures on Bitcoin, the S&P, even crude oil, on weekends when regulated markets are closed. One desk says it has beaten Ethereum in trading volume on some days. Its real-world asset open interest just hit a record $3 billion. And OpenSea is building perpetuals on top of it. While the majors rotate out, the plumbing of crypto keeps getting built. There is a cross-current worth noting too. Even as the ETFs bleed, corporate Ether treasuries are buying the weakness. Tom Lee's BitMine added another 25,000 Ether this week, and Standard Chartered floated that strategy's sale could mark the start of Ether outperforming Bitcoin. When prices fall and the long-term buyers step in, that usually earns a second look. From here, watch the outflows first. A single $500 million day is manageable. A full week of them is a different conversation. Then watch whether Bitcoin holds the $60,000 to $65,000 zone the long-term desks are calling support. One analyst is already calling for a choppy summer. The geopolitics, fresh US sanctions on Iranian exchanges, tension around the Strait of Hormuz, is in the mix too, but it is background noise next to the flows. Because here is the read that matters. The tape looks like crypto breaking. The flows say something quieter. Nothing is wrong with crypto right now. The smart money just found something it likes better. That is not a crash. That is a competition for capital, and crypto is losing this round. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.